Hello, and welcome to the June Market Update. I'm Brad McMillan. I'm Commonwealth's Chief Investment Officer. It's been a strange month. We've got a couple of things to talk about. First of all, the financial markets that actually opened slow but then finished strongly for both stocks and bonds. Second, the economy, which again started quite slow, but there was a lot of good news during the month. And finally, what this all means for you. Let's start with the financial markets. U.S. stocks started out slowly, bounced around a bit, but then it seemed to have finished the month off very strongly. We're seeing some strong gains. That's largely a reaction to the accelerating growth in the economy as a whole. We actually saw some pullbacks during the month. We saw growth stocks, we saw biotech stocks, stocks that had really run up too far, pull back a bit. And that's actually a healthy sign, even though it created some concern at the time, because that means that the market is working. Prices are adjusting back to reality. The interesting thing about the credit markets, though, is that interest rates actually dropped towards the end of the month. And that actually creates some concern because the problem is when interest rates drop, that usually means an economic slowdown coming up. I don't believe that's the case. I believe there are technical factors, supply and demand factors that are driving interest rates lower. And actually, I think that will help juice the recovery even more. Something I'm keeping an eye on. But both of the factors from the financial markets are actually quite positive at the end of the month. The economy is also doing pretty well. We found out at the end of the month that the first quarter was even worse than we thought. Instead of being essentially flat, it actually shrunk by about 1%. Now, that's obviously not a good thing, but the good thing is it's not a result of the economy slowing. It's a result of the weather. We know that for a couple of reasons. First of all, the sectors that were hit the hardest are the ones that you would expect to be hit. Second of all, because the data has actually been coming out much more strong recently, and what that means is with better weather, we're actually getting the real signal here. Let's look at some of the things that came out. First of all, employment went up by 288,000. That is a very strong number. It's the strongest number we've had in quite a while. Second of all, the initial jobless claims, people filing for unemployment, dropped down to a 7-year low. That's very important because that means that employment is growing. It means that companies are retaining their existing workers, and we're actually seeing consumers start to spend and start to borrow more. We're seeing companies start to invest and start to borrow more. All of this reflects growing confidence, which is exactly what we need. Housing continues to do well. We're continuing to see double-digit price increases. Even though it's slowed a bit, that again is a healthy thing. That is the market at work. When we look at everything we've got here, we see the economic recovery actually starting to accelerate. We see people starting to buy into the recovery. We see people start to say, yes, this is what I want to do. And the stock market is reflecting that. There are still things to be concerned about. Europe is not going away. China is not going away. And we really do need to see employment continue to perform strongly. But at the same time, spring is finally here. The snowdown is over. And I think we're going to look forward to a strong couple of months. Thank you very much, and I'll talk to you next month.